Rates are coming down, but not like you think. Let's cut the fluff. Here's what's really happening in commercial real estate. Many people are anticipating that when the feds do lower the rates, they will be able to borrow on the commercial real estate at a lower rate. Not necessarily true. Here's why. The biggest reason is that the feds control the overnight funds. You borrow long-term, 5-year, 7-year, 10-year, which is typically gauged by the 10-year treasury. So that's one difference. But more importantly, here's what's really going on. There's two components that make up your interest rate. There's the cost of funds. Let's call it the Fed borrowing rate. What are the interest rates the bank has to pay the feds or that the bank has to pay the depositor? Let's say that's true, that's lower. However, there's another piece of the puzzle, and that is the spread, which incorporates reserves for losses, operating expenses, etc. That's how the bank makes their profit. That number is not getting tighter. And that number, in some cases, getting wider. Because as more losses are taking place, banks now have to start underwriting for potentially bigger losses. Several years ago, when you look back even further back at that point, they weren't losses. So the banks were able to justify that, hey, these loans are so safe, and therefore the rates were low, the cost of money was low, and the spreads were very tight. Now, you have the spreads widening, so even if you're getting short-term money is lower, the long-term is not that much lower, plus you still have those spreads that sometimes are even widening for staying where they are today. What are your thoughts how it ultimately shake out between Fed rates as well as where spreads are going? Because that's the big thing we got to watch.